Darshita, we have the TCS numbers coming out in the evening. What's the expectation from the street?
Right, so TCS is all set to kick off the IT earnings season today, and this quarter the street will be watching margins more closely than the revenue. So the revenue growth is expected to remain largely flat in dollar terms, while in the rupee terms it could see a modest growth of about 2% sequentially. However, the trigger and the bigger concern is the profitability, where the EBIT margin is estimated at around approximately 23.9%, which is down nearly 141 bips sequentially. And if TCS reports a margin around these levels, it would mark the lowest quarter-one margins since Q1 FY24 or the lowest in the last 11 quarters. PAT is also expected to decline slightly on a sequential basis. So what's weighing on the margin is primarily the reason is annual wage hike, but apart from that, ongoing investments into AI capabilities and the AI-driven pricing pressure are also emerging as additional headwinds. And now remember, the management had sounded quite optimistic about FY27. So the key question in this quarter is, are we finally beginning to see the early signs of that optimism translating into the business performance? And apart from the numbers, investors will closely watch the TCV, which is expected to come in between $9 to $11 billion, along with the commentary on the demand environment, especially into the BFSI segment and the impact of the currency tailwinds. So overall, the headline numbers may look muted. The management commentary that could end up driving the stock ahead.
Thanks, Darshita, for that update on the TCS. So the muted expectation for TCS Q1 numbers. Sandip Agarwal joins us. He's a fund manager at Sowilo Investments. Sandip, TCS numbers coming out in the evening. What's your expectation?
Hey, hi, good morning. So, we don't project numbers for a particular company because I run a PMS, but we do project the sectoral level numbers. So our reading for this quarter is that, this quarter we have seen some that, beginning April, the disruption in the Middle East was quite high. So a lot of companies, although they have very small exposure to these markets, but still, those markets will be in some trouble right now. And because of that, there could be some misses on that. But broadly, say after March, my view on the sector has turned very positive, and I continue to maintain that sense and that stance. I don't think this quarter numbers should be read too much, because I believe that large part of the deflation of the AI related effort reduction will show up in this quarter, and probably after this you will see a big jump in numbers from next quarter onwards. So I am reading more like this, that this is the inflection point of the sector. This quarter will be the inflection point, and from here things will turn around. Having said so, I think different companies will report different number, right, as rightly mentioned, from minus 0.5% to 4.5%, with best numbers coming from Coforge probably, and probably weakest number coming in from TCS, Wipro, and like of that. So, but as I said, that this is the inflection quarter, and the commentary will be more important rather than anything else. And I believe that commentary will be more positive and forward-looking.
Very interesting, Sandeep. I just want to take it back a little bit and rewind here, because I recall you were one of the first ones to go negative on IT, I think about 14 odd months back, if not more. And now you flipped to very positive, I think in the last 6 weeks or so. Tell me what specifically changed, and is this purely a valuation call, or do you think things will turn around really for the IT sector?
No, so, as you absolutely rightly said, 14, 15 months back, what I was saying was that, a new disruption was coming in AI, and that was definitely going to reduce 30-40% of the effort, which has never happened in any past disruption. So in past, if you see last 25 years of disruption, 4 disruptions have happened. Every time what has happened, that a new technology has come. So Indian IT companies, for 12 to 18 months, they have to retrain their workforce in that technology. And then the demand which comes, that covers up for the loss of 18 months of growth, right? This is the first disruption where effort itself is going down by 30%. So forever your 30% effort will be lower. So it is a totally different disruption, and that is the reason I thought that at that time that this multiple and the PEG ratios of 6-7 times for the sector are very, very overvalued, and at least 40-50% correction at the index level should happen. I think that has happened now. Now what is happening? 2 things are happening. One, you have to understand that that thing 15-16 months of that has happened, and I would say rather 18 months have gone by. So what has happened that the disruption of the technology definitely has happened, but most of our companies, the effort reduction, which is the main cause of worry, or the 30% deflation in the revenues, that large part of that is into the numbers. Maybe this is the last quarter where it will happen. Second, they have been able to understand the technology, new technology. They have been able to recruit right people. I'm telling you, there is so much demand of AI experienced people right now. Everyone is looking for them. There is huge demand, and there are people available also, by the way. I'm not talking about LLM type of people, but broadly the workforce which is required to execute our IT services projects in the AI space. Lot of workforce has already been trained, and it is now moving from one place to another. So they are also trying to come out of that 3 years of no salary increase and all that. So I think it is a very, very positive sign. Now remember that we have 96% market share in global sourcing. So you cannot expect this sector to be a double-digit growth sector. I think it is a mature sector. So lower growth for longer is the theme. So 6-7% dollar growth. But the next 5 years will be much different than last 20 years, in the sense that last 20 years, whatever extra money you have made because of dollar appreciation and everything, you have reinvested that and passed on that to the client in some or other form. We are largely done with that process of localization also. Now I don't see any area where you will have to invest big money in the cost side, maybe on the R&D side. So I think the next 5 years, the saga of Indian IT will be lower growth but much higher profit growth. And I believe that, and based on the numbers I have done, I think the EPS growth, depending on the companies, can be 45% to 70% cumulative growth for next 3 years. And even if the stocks don't re-rate, I think that is the minimum return which you will get, and which is a very good return in liquid stocks like IT with good management and good cash balance. So I think on a CAGR basis, 12-13 to 15-16% EPS growth consistently for 3 years, this is the sector where it should happen. And I believe that without re-rating also, you will make that kind of return annually.
Sandip, you mentioned that this quarter is going to be an inflection point, because you're going to see a major impact of the revenue deflation there. According to you, which company will see the maximum revenue deflation?
So I will tell you this, that again, we will not go into specific company name, but I will tell you this, that ER&D still has not is not out of froth. So ER&D, so 15 months back when I was saying 50% correction in IT sector index, ER&D was 70%. So ER&D, I think still 15-20% froth is there. Let it correct. So I am continuously cautioning people that don't be in ER&D. There is a lot of weakness which will happen there. Also remember that there is a volatility in European auto. Also, all this AI related efficiency which is coming maximum on the R&D side. So ER&D has a lot of that angle. So remember, the effort reduction in ER&D will be much higher than effort reduction in traditional IT services or enterprise AI. So I think that ER&D you should not buy, you should avoid. But definitely, traditional IT services will do phenomenally well. And let me also tell you that inflection point is what? Minus 0.5% growth or 1% growth. There are so many companies with 80, 90, 100 multiple for last 10 years, and they grow at 2-3% year-over-year growth, and they don't correct. And here is a sector which is, at 10, 12 times price earning. And what is the worst quarter number? It is 0.5% negative growth. So I don't think that, this stock should correct from here. But the problem is that, if 10 people start calling a cow a lamb, then people start believing it. So what is happening? Everyone is talking about AI globally. All the analysts are also talking about AI. All channels are talking about AI. No one is talking about the IT services, and no one is, coming out with clarity and defending it also. And management, our IT company management has always been like that. They don't want to, look at, come and, give too much bullish commentary and all that. So we are caught in that. In my view, next 1 or 2 quarters will clarify what is the strength of Indian IT. And I think that we will see good return from here in this index. Again, we will reiterate, this is not a 10-12% growth sector. It is a 6-7% growth sector. But I still believe at 6-7% dollar growth with 2-3% rupee depreciation and also some efficiency, it is a 12-13% earnings growth and with a lot of dividend distribution. I think it has to re-rate a little bit. And even if not re-rate, that much return every year should come, and liquid. So very, very good space to be in.
Sandip, it was a pleasure talking to you and getting a perspective on the IT preview and what's your view. And you've turned really bullish on IT at these valuations. Thank you for joining us today. Meanwhile, the Prime Minister is